All right, we'll start. We're recording. Maybe other people will pop on in, but we will just go on through. So I'm Sean, and we're going to explore where value falls in crypto assets. Like I teased on Monday, the most interesting question in crypto to me is where value falls at different layers of the crypto stack and how different companies and protocols are trying to capture that value. This presentation is overstuffed and it's messy. It's occasionally incendiary, and it's really the result of me just trying to sort through my own thoughts on these subjects. I'd love to see activity in the chat where you guys are saying that I think this is wrong or the wrong way to look at it, or I think the opposite, because I'm not giving any answers here. I am just like organizing the questions and giving my own thoughts on them. I'm going to talk fast because I'm not sure if we're going to end up closer to 40 minutes or an hour. I could have made this shorter, and I probably should have, but I wanted to throw as many ideas at the wall that I could. So thank you in advance for sitting through this, and let's do it. So this presentation is broken down into 5 sections as listed here. After each section, I will pause for a second to scroll through the chat, and I do encourage all thoughts and questions. The first 2 sections might be a little bit rote or basic for some of our cracked devs, but it's kind of necessary to lay the foundation before we dive in deeper. A lot of this stuff has been like hinted at or implied in all hands, or it might just be understood implicitly by some of you, but it's good to just kind of like walk through everything here. So before we even dive in, I just want to take a second to separate out these like 3 broad categories within crypto, because we're going to be talking a lot about infrastructure and apps. So one explicit call out is that I'm going to grossly oversimplify an enormous amount of things in this presentation. So first you have your base layer blockchains, like both layer 1 blockchains like Bitcoin, Ethereum, and Solana, and layer 2 blockchains like Arbitrum and Base fall into this category. These are foundational platforms that you launch your crypto app on top of. Then you have apps, which are what you directly interact with if you're taking actions on a chain. So things like lending protocols, perpetual swaps, buying NFTs are apps. And then lastly, you have middleware, which are crypto apps, blockchain apps, which are crypto apps, but rather than interact with them directly, they usually operate in the background and are used by apps to do something. So Chainlink oracles give you price feeds, Arweave stores NFTs, Wormhole will help you bridge. This is all crypto middleware. So let's do a very quick state of the union of the major L1s this year to set the stage on base layers before we get into apps. So Bitcoin has had a big year. It's gained recognition from institutions, politicians, and even nations. It's being positioned as the non-sovereign store of value, finally on the brink of nation-state adoption. But is this the long-awaited super cycle? What is going to happen here? Meanwhile, Solana has been making serious strides with the on-chain transaction activity rapidly catching up to Ethereum's. The speed and low fees have made it a hub for high traffic use cases, but scaling a layer 1 has challenges. The hardware requirements are high, and as demand grows, it's fair to ask if Solana's approach can scale indefinitely, but we can't ignore its momentum. And Ethereum is facing some growing pains. The move of activity to layer 2s has fragmented liquidity. It's created friction for users. And while layer 2s help with scaling, they've also raised questions about Ethereum's long-term value capture. So does being the settlement layer for so many layer 2s strengthen ETH, the asset, or does it shift too much activity away from the base layer? Super basic 101 on scaling blockchains, literally as basic as you can go. Blockchains produce blocks. The bigger the blocks, the more transactions you can fit in. But the bigger the blocks, the more powerful the computer you need to produce the blocks. And if you produce blocks fast, you need an even more powerful computer. So the more powerful the computer, the few people can run the software, which hurts decentralization. So more blocks and bigger blocks mean faster and cheaper blockchains, but also big, beefy computer requirements, and this is a centralizing force. Bitcoin produces small blocks slowly, and the blocks are stupid, right? They're just transactions. Bitcoin is good at what it does, which is being simple, but Bitcoin's blocks are so simple, and this is a problem in my opinion, that you can't easily build layer 2s to scale it. So I have a couple jokes here, but just keep in mind that I love Bitcoin. Bitcoin's blocks are so dumb that they think scaling solutions are for measuring fish. How many Bitcoin blocks does it take to screw in a light bulb? None, because Bitcoin can't screw in light bulbs. It just hodls in the dark. Why did the Bitcoin block miss the bus? It was still waiting for confirmation. So, all right. There are actually positives to Bitcoin's long, small blocks, but we will move on. Ethereum produces pretty small blocks, medium, and the blocks are smart. They can run smart contracts. And Solana produces big blocks fast. They are smart and they can also run smart contracts. So layer ones are important because they've been the centerpiece of the crypto ecosystem and they command the highest valuations for one reason. They have this promise of becoming non-sovereign stores of value, and store of value is the biggest game on the planet. And with fungible assets, store of value comes down to this idea of monetary premium, the idea that assets with store of value potential are valued far beyond their actual practical utility. So gold's $15 trillion market cap, for example, is not just due to its industrial use, it's because gold is a trusted store of value. But what actually makes an asset a store of value? Is it just being first and having a certain supply properties and network effects like Bitcoin does? Or does it require a combination of utility and productivity? This question of like digital gold versus productive economic asset is really, really interesting because how many store of value winners will there be? Most people seem to think that there's going to be like one giga winner with a few other smaller but significant ones. But I actually think that there could be room for two giga winners, one gold-like and one productive. So this is all just like foundational setting the stage stuff. So every layer one blockchain has a unique approach to capturing value. Bitcoin is kind of the purest expression of monetary premium. It doesn't generate cash flow or act as a productive asset. Its value is driven exclusively by its fixed supply, simplicity, and growing collective belief that it is this digital gold. The focus on decentralization and security comes at the cost of usability, but that is the trade-off that Bitcoin was designed for. Solana is at the opposite end of the spectrum. It is a highly productive asset. It generates significant fees through its high throughput blockchain. And so Solana is kind of like the Walmart of crypto. It's accessible, fast, and cheap for all kinds of activity. Its value lies in being the go-to network for applications, but it sacrifices the strong monetary narrative that Bitcoin holds. Meanwhile, Ethereum is trying to do both. It is trying to position itself as both money through staking and fee burning, and a productive asset via the application ecosystem. And so while the dual strategy makes Ethereum versatile, it also introduces a lot of complexity, both developmental and currently, importantly, narrative. So what's really interesting here is that like we know Bitcoin is special, its story, its conception, etc. But it's also special in the sense that no other crypto asset today could come out and just say, I want to be money. Bitcoin's moneyness is pure story, and that won't happen again. Other assets like ETH and SOL are trying to emerge as money through use, and that is very interesting. So each approach has its strengths, but the question remains, which will prove the best? Spicy takes coming in about 30 minutes. So Ethereum's approach to scaling has created both opportunities and challenges. Its small block design focuses on decentralization and security, but it also means that Ethereum's layer one will never be as fast and cheap as alternatives. So to scale, Ethereum relies on these layer twos, and there are many. The good about this is that the L2s help Ethereum scale while keeping the layer one secure. Most L2s use ETH as the gas token, which reinforces ETH's role as money within the ecosystem. You need ETH to transact on these layer twos. But the bad is that activity moving to layer twos fragments liquidity badly, and it makes the user experience less seamless. And it also raises the question of if most activity happens on other layers, does Ethereum's layer one lose relevance? So can Ethereum maintain its layer one relevance while embracing the growth of the L2 ecosystem? And so every layer one blockchain has its own challenges, and none of them are the perfect solution. Bitcoin's strength lies in its simplicity, but the minimalism comes at a cost. Bitcoin's blocks are so limited that the network can't effectively interoperate with other blockchains or build good layer twos. For example, you can't use BTC trustlessly on Ethereum or other chains without involving centralized intermediaries. This lack of interoperability could hurt Bitcoin's relevance in a future dominated by interconnected multi-blockchain ecosystems. And so while Bitcoin remains unmatched as a digital store of value today, its inability to interop might become a long-term liability. Its main layer 2 up to this point, a simple payment network called Lightning, has had mixed success so far. One more joke. Bitcoin's blocks are so dumb that they thought the Lightning Network was the Weather Channel. Okay, anyway, Solana has taken the opposite approach, right? High throughput scaling directly at the layer 1. But this will run into the physical limitations of what distributed systems can do. So as Solana keeps scaling, it's going to require increasingly specialized and powerful hardware to maintain its performance, which is centralizing. And Solana's lack of a strong monetary policy limits the ability for it to be taken seriously as a store of value, which could cap its long-term potential in a market where money is the biggest TAM. Now, Ethereum's small block design and the focus on decentralization have forced it to embrace these layer 2 scaling solutions. And while it might work in the long term, it has created really, really significant short and medium term challenges. Ethereum's narrative has also become muddled because it is trying to be both a productive asset and a store of value while juggling the layer 2 development roadmap. And it creates all this confusion about what it's supposed to be. If I am being honest, Ethereum's layer 2 first approach feels like the most correct long-term vision for blockchain architecture to me, but by focusing so heavily on the future, Ethereum has neglected the present. And so what people use blockchains for today is mostly just to make swaps, dabble in DeFi, buy NFTs and meme coins, and that level of activity is scalable on one layer. But by skipping ahead to the building the future for 5 years out, Ethereum has hurt its UX today to the point that Solana is genuinely catching up in economic activity, and the chance that Solana flips Ether is not zero. So how do you value that? Right long-term vision, maybe, but real present danger? I have no idea. So as we've seen, each main layer 1 offers a unique vision for how blockchains can create and sustain value, whether pure store of value like Bitcoin, high performance like Solana, or a layered middle approach like Ethereum, but they're all deeply flawed in their own ways. And so but they're all deeply flawed in their own ways. End thought, new thought. One last big question is, will layer 1s continue to dominate total crypto market cap? Or will the rise of layer 2s, middleware, and application layers redefine where value is being captured in the crypto stack? Because to date, it's layer 1s that dominate valuations, but is that going to change? Let's explore it. So transition, new section, FAT protocols. This is the shortest and it's the most basic section of the presentation, but it's important because it sets us up to start talking about crypto applications next. So let's start with a concept that has become kind of foundational to understanding blockchain ecosystems, the FAT protocol thesis, originally written by Joel Monegro in 2016. This is a framework for understanding how value is distributed in blockchains compared to the internet as it has developed up to this point. So first, a protocol to begin with means a standard or a set of rules. If someone asked you to define the internet itself, you might have a hard time, right? To way oversimplify, the internet is a series of standards that computers can use to talk to one another. It is a common way of communication. Protocols are rules or standards. Now with the internet, the web's foundational technologies, which are protocols like TCP/IP, TCP/IP, HTTP, and SMTP, have produced enormous amounts of value, but that value is mostly concentrated in the applications that are built on top of the protocols. Google and Facebook have made a ton of money, but TCP/IP has not. So Web 2 has these thin protocols and fat apps where applications are capturing the lion's share of economic value by controlling data and building walled gardens around it. This dynamic has led to a world where investing in applications has produced high returns, while investing directly in protocols has yielded basically nothing. Blockchains turn this relationship on its head. In crypto ecosystems, value so far concentrates at the protocol layer, with applications only capturing a fraction of that value. Joel Monegro's term for this is the fat protocol thesis. In crypto, layer one blockchains like BTC and ETH have captured most market cap value in crypto. If you compare the market cap of Ether at 400 billion to its top spot application, which is Chainlink at 26 billion, the protocol is valued way more than the app, and that app is middleware, but whatever. This is completely different than the internet, where companies like Google and Facebook massively overshadow the underlying protocol in value. This might be starting to change though, because applications are starting to generate real fees, but we'll get there next. For now, crypto gives value to the protocol technology. So unlike traditional applications, blockchain protocols are open systems. And so applications can compete on user experience, but you can't lock a user in the same way. And because you can't lock users in, you have to consistently compete with other apps, and other apps are constantly cropping up. So it's hard for any one app to dominate. And while fat protocols have been true when it comes to layer one blockchains, middleware protocols are emerging as a critical part of the crypto stack. These are behind the scenes systems that power applications. So examples might include the Graph for querying blockchain data, or Chainlink for connecting off-chain prices to smart contracts, and Layer 0 and Hyperlane for cross-chain messaging. Do middleware protocols that power apps and are undoubtedly providing a valuable service capture value in a way that stays true to the fat protocol thesis? Or do they go more the way of protocols from Web 2, where they don't capture as much value? And for apps built on top of both base layers and middleware, we are starting to see that they are really starting to grow. So surely, apps are not going to want to give away all the value either to the underlying layer one or the infrastructure protocols in between them, right? So to conclude this section, so far blockchains have inverted the internet value model, with fat protocols capturing the majority of the value in the crypto economy. This is very different than how it works with traditional Web 2 companies. And so protocols have captured value so far in crypto, not applications, but that is starting to change. Transition. Rise of apps. So now we're going to talk about apps a little bit more and how the crypto economy is shifting. I am here to tell you that over the last few years, crypto has evolved from purely speculative experiments to active economies that are driving real monetary value. Here, we are going to chat about the rise of applications, their growing role in capturing value, and how this is reshaping the relationship between applications and blockchain infrastructure. So there's a common trope that beyond Bitcoin and stablecoins, there aren't any valuable applications in crypto. Critics would argue that the last cycle was driven purely by speculation, with little progress made since the 2022 crash. These critics claim that the industry is oversaturated with unused infrastructure. While there's a little bit of truth here that infrastructure has been overfunded, the reality is more nuanced. We are seeing secular apps emerge as winners at the foundation of the crypto economy. Contrary to popular belief, the age of applications is upon us, with platforms like Ethereum and Solana hosting applications that are generating real revenue and experiencing triple-digit growth. However, despite the success is, these applications trade at big discounts compared to infrastructure, a trend that may not hold much longer. And so the interesting question is, who gets to capture the value? Does value flow down to the layer one like it has before? Do the rise of middleware protocols get the value, or can apps claim the value themselves? So this chart highlights how the dynamics of value in the crypto ecosystem are evolving. The blue bars represent revenues from infrastructure layers like Ethereum, Solana, and other L1s and L2s, while the purple bars represent revenues from applications built on top of these layers. What's immediately striking is that applications are capturing a growing share of on-chain revenue. In some cases, they're even outpacing infrastructure projects in layer ones, which have traditionally dominated value capture. So apps like Maker, Aave, Jupiter, and others are thriving, and they're leveraging these base layer platforms to deliver valuable services to users. So if you look at MKR here, a lending protocol, it is a price to earnings ratio, a very common TradFi metric of 6, which is really low for this kind of technology play. And so another key observation here is like the absence of middleware protocols. And so middleware, such as indexing protocols or cross-chain messaging systems, they play a crucial role in enabling applications, but most of the visible economic activity here is concentrated in the foundational layers and the applications. And this underscores like a critical trend. While middleware provides essential infrastructure, it's the applications closest to the end user that are capturing the most economic value. And this chart represents also a growing diversity of economic activity. While Ethereum and L2s remain dominant, Solana apps are proving that revenue generation is not confined to just one ecosystem. These applications are showing that real economic activity, and these are some significant numbers, is occurring on multiple chains. And I will note here that besides Ethereum and Solana, no other blockchains are generating any meaningful fees at all. So the rise of apps raises an important question about the long-term distribution of value in the crypto space. Will apps continue to grow their share of revenue, or will infrastructure layers attempt to capture more value? As the ecosystem matures, we may see that the lines between these categories blur, with middleware protocols and hybrid models finding ways to bridge base layer infra and apps. And this is something that like at Eco we have to deal with as well here too. And so just because apps might generate value, that doesn't necessarily mean that their token will go up in value. They're two totally different things. We would love for apps generating revenue to mean that token goes up, but they do not have to. I just told you that Maker has a really low PE, and it's generating $250,000 a year in revenue, which is insane. So why don't I, Sean, own any Maker? Well, it's an old coin. People have memed about how it never goes up. They're in the stablecoin space, which is exciting, but like I don't think they have the coordination to compete, or they might get regulated away, and it's all super complex. So on-chain revenue does not necessarily correlate to token price. But one thing that is for sure is that the age of applications as revenue-generating machines is here. These apps are delivering real value while living entirely on-chain. And so this brings us to a fundamental shift, the rise of fat applications. As apps scale, they're demanding more from the infrastructure beneath them: custom execution environments, alternative economic models, specific access controls, and customized transaction ordering mechanisms. These demands for like custom space are driving apps to develop their own rollups or their own chains to give them economic control. So if you take Ethereum as an example, leading applications are building custom rollups, allowing them to optimize the user experience while reducing operational costs. And so part of what I'm talking about here is as your app, like Uniswap launching Unichain, reaches some critical mass of users, you may want to develop in a way to customize the experience a little bit more. And so you don't necessarily want to have to wait 12 seconds for an Ethereum block to be produced or for Solana congestion to pass. You want to own the user experience entirely. And so apps are looking for ways to own everything and become infrastructure. So what does this mean for value distribution? Will applications eventually surpass infrastructure in value capture? While apps are poised to claim a greater share of fees, foundational blockchain assets like Bitcoin, Ether, and Sol still compete as non-sovereign digital stores of value, which is the largest addressable market in the crypto economy. And there's also a real interesting distinction here with Bitcoin, which is a pure commodity money asset. In contrast, Ethereum and Solana are building these like, instead of just digital store of value, Ethereum and Solana are building parallel economies in cyberspace. And so these ecosystems are creating organic demand for their native tokens, ETH and Sol, by acting as mediums of exchange, units of account, and pristine collateral within their economies. So again, it's just like Bitcoin is this story, whereas Ether and Solana are trying to emerge as money. So if you're a middleware protocol, you're in kind of a tricky position here. You don't generate a ton of fees the way applications do, but you also don't get store of value status because you're not an L1 blockchain. A lot of talk is if there are two layers in the stack, the app layer and the foundational layer, but really there are three layers: foundational, apps, and middleware. So maybe both can be true, where fat protocols prove true for the foundational blockchain protocols and the apps that are generating revenue on top of them. and the middleware, of which there is a lot, how does it shake out? So even this is not so simple because eco does not fit so cleanly into this framing. And I am going to punt on where it fits for now. So to understand where this can lead, just let's take a second to think about the internet boom of the 90s. At that time, as the internet was expanding, telecommunications companies received a lot of investment to build out this infrastructure, but a lot of the value ultimately accrued to applications that were built on top, like Google, Amazon, and Facebook. And so it's possible that a similar shift could happen in crypto, where blockchains provide essential infrastructure, but ultimately get outshined in value capture by the application layer. For now, the crypto economy is not really working like that, and it's just chasing after each other. So like Bitcoin is chasing gold, Ethereum is chasing Bitcoin, Solana is chasing Ethereum. And like, when are we going to stop chasing and start reaching end state types of valuations? Probably not for a while. Case study. So let's take a moment to dive into a relative example here about cross-blockchain communication, which is an area that we are playing in, to look more closely at the app layer and infrastructure. I am out of my depth here because we have a team of literal experts on this subject, but I'm going to do my best because it is still helpful to go through. Part of why it's tricky to talk about some of these concepts is that it's not so easy to discern between middleware and an app sometimes. Eco, for example, is an infrastructure app that is sort of middleware, but it also sits on top of other middleware, and you can interact with it directly like an app. So that's confusing. For this section, I am going to oversimplify, and I am going to call us an app. And so who gets to capture the value? As crypto is evolving, one thing that is clear is that many more blockchains are going to launch. The reason for that is that there is an incentive to launch. If you launch a blockchain and you launch a token, you might make a lot of money. How these blockchains communicate with each other and who gets to capture the value of that communication is a super interesting question. Now, if you step back for a second, again, we've been talking about how there's multiple layers of the crypto stack. There are the blockchains themselves, blockchain infrastructure, and the apps built on top of them. Bitcoin, Ethereum, Solana, along with others like Avalanche, Sui, Aptos, Arbitrum, Optimism, are blockchains. These are the ledgers that apps built on top of. Then there are the crypto apps like Aave, Uniswap, Jito, Jupiter, and a million others. These use the shared global state of a blockchain to allow users or businesses to do something. So they are applications. And then there are middleware protocols that apps build on top of. And all of these parts of the stack either have their own tokens or are going to have their own tokens, but they can't all be multi-billion-dollar valuable at every level, right? So one big question is how applications on different blockchains communicate with one another. And if you want to swap assets between blockchains, how do you do it without relying on a centralized company like Coinbase? Because even though blockchains are global, they're siloed within their own ecosystems. And so this is why many companies are working to solve the issue of cross-blockchain communication. So time to way oversimplify again. But this could be helpful if you don't fully grok what we're talking about with our own app when we talk about eco. And I don't always fully grok what we're talking about when we talk about eco. But in cross-blockchain communication, there are often two primary layers that lead to you going between chains. And it's not clear yet where the value is ultimately going to be captured. These layers are the messaging layer and intense applications built on top of them. So messaging is all about how blockchains can actually talk to one another. So put simply, how can an action on one blockchain trigger an action on another blockchain? This is what Layer 0 and Hyperlane are working on. They are message passing protocols where distributed validators are running software across multiple blockchains to enable cross-chain actions. These validators monitor different chains to verify that if I perform action X on chain Y, action Z can take place on chain A. So in essence, these messaging protocols are providing the core plumbing between isolated chains. They're this core infrastructure. And then there are intents and intent-based applications. So remember, we're talking about bridging assets between blockchains here. And intents are when a third party gives you money on the other chain before the messaging layer says, okay, you're settled. And so to make this more concrete, imagine that you want to bridge USDC from Ethereum to Solana. Messaging protocols need to wait for blockchains to settle. So if an Ethereum block occurs every 12 seconds, I cannot complete your bridging transfer until those 12 seconds pass. And it's actually longer to fully finalize. With an intent-based application, a third party can give you your money on Solana immediately. They front you the money for the bridging, and then after the 12 seconds, when the blockchain settles, they collect what you originally bridged. So intents in bridging, rather than building this like low-level core infrastructure, intent protocols let outside parties help users perform their actions faster and cheaper than what messaging layers can offer. And these third parties are often called like fillers or solvers, like we say here, that give you the USDC on the other side instantly so that you don't have to wait for the messaging layers to settle. And so some group, and it can be done permissionlessly and trustlessly, fronts the asset on the other chain. And once the Ethereum block is finalized, they are made whole and they typically collect a little bit of a fee. So messaging is core infrastructure for cross-blockchain communication, while intents apps function more like businesses. And so even though intents rely on messaging for confirmations, their goal is to service user demands quickly for a fee. But where does the value really accrue? Who gets to capture that value? That's the big question, and I don't have the answer yet. All of these protocols either have tokens or will eventually. The idea for all of these companies is that their success drives value to their tokens. Hyperlane, for example, that is the powering our hyperprover and hyperroot. Hyperlane is hoping that by us using them for messaging, it will eventually accrue value to the Hyperlane token, which is not out yet. While we hope that using Hyperlane is going to bring value to our token. But does more value come from the infrastructure layer like messaging or from the application layer like intents? Typically, in a business, the closer that you are to the end user, the more power you hold and more potential to capture value. If users are coming to your app, you control the funnel, which is highly valuable. Intent protocols are going to sit closer to the user. But there's also a general market dynamic to consider here as well, which is how crowded is the market. And so if there are a dozen messaging protocols, but only 2 or 3 dominant intent apps, the app that controls the users controls the flow. And so it can simply pay for the cheapest messaging because there's so many messaging providers that nobody cares. But on the flip side, if there are a dozen very similar bridging intent apps competing, but there's only 1 or 2 dominant messaging protocols, then perhaps value will be able to be captured by the messaging infrastructure. And so in the end, the question of where value accrues may not just come down to the inherent dynamics of sitting closer to the user. It may also be how competitive each market is as much as anything else. And so one thing I find really interesting here is that I see the value for intent businesses. There's an obvious fee-driven valuation model there, which is what we've been talking about with the rise of apps. But the messaging layers, the middleware, are finding unique ways to become entrenched. And so an example of this is that if you want to launch a cross-chain token, so a cryptocurrency that exists on multiple chains at once, you're probably doing it on the layer 0 OFT standard or the wormhole NTT standard. So in a way, these messaging middleware protocols have ingrained themselves in the very existence of other cryptocurrencies that use their standards. Because if the Athena token uses the layer 0 standard, they really need layer 0. And so is that economically valuable? Maybe, but it is hard to model out. And so while messaging protocols provide the core infrastructure, the nature of user-facing applications suggests that the intent layer may have the edge in value capture. Now, is there enough value to go around for everyone, or does there have to be like a winning and a losing layer? That is something that we will see. So take a second to pause here. And then we've just got one more section. So we've been talking about the foundational layer one platforms capturing most of the lion's share so far, how protocols have been capturing most of the value in crypto, how the rise of apps might be changing this. And then this is just going to be loosely related topics that I'm intrigued by that stem from what we've talked about so far. This is the last section. So would you rather be an app with a product built directly for end users, like a lending platform, or would you rather be the infrastructure that powers that app? It is a critical question for the crypto ecosystem, and each approach has its own strengths and challenges. Apps have the advantage of being closest to the user, which gives them potential leverage and influence. They directly control the user experience and set the terms for engagement, and they capture activity through their app platform. The proximity to users means that they can build strong, recognizable brands and create sticky ecosystems. But at the same time, the competition among apps can be fierce, especially with open source software. Now, on the other hand, building infrastructure, the protocols that enable apps to function, is inherently valuable as it provides the foundational services that apps rely on. So infrastructure protocols play a critical role in creating interoperability, scalability, or efficiency across ecosystems. But just because the service is essential doesn't guarantee that the protocol or the token associated with the infrastructure will reach or sustain, multi-million-dollar fees or multi-billion-dollar valuations. Many infrastructure tokens struggle to bridge the gap between utility and economic value capture. So the reality is value capture depends on how competitive each layer is. If multiple apps rely on your infrastructure, you may hold pricing power. But conversely, if your app dominates user attention, you control the flow of activity. And so ultimately, success depends on whether you can capture and sustain value, regardless of where you sit in the stack. And it's worth noting, obviously, that there's no obligation for anyone to buy any token. There are a lot of investable assets out there, and just because a crypto product is generating revenue does not mean that the token price must go up in the future. Okay, even though we are literally doing it, I want to take a moment to talk about how hard it is to launch a economically aligned cryptocurrency. We want to make it so that any blockchain and app can get stablecoins on their chain and that they and applications and users can seamlessly send and accept stablecoins across all of these chains. Okay, but how does the token fit in? A cryptocurrency is inherently an incentive mechanism. It is a way to encourage a certain type of behavior or reward a certain type of behavior. Typical Web2 companies build a product and they try to sell it, while crypto projects have this extra tool in the quiver of this incentive mechanism, the token. So we can build the product, but how do we leverage our token? There are a lot of different parties that we need for our product to work at its best and be decentralized. We need chains that want to integrate with eco to get stablecoins on the chain. We need users who want to bridge stables onto apps. We need to incentivize solvers who are willing to front money on the destination chains so that if you want to bridge $1 million, you're able to do that. We need to incentivize crowd liquidity. Maybe we want to incentivize provers for extra guarantees that the money did settle, but maybe not. We need to incentivize holders of the cryptocurrency so that there's a reason you would actually desire to hold the coin. And we need to incentivize market makers so there's enough volume for people to actually trade it on exchanges. That is a lot. And our cryptocurrency and the exact specifics of how it works in our system really matters in how well the entire system functions. Cryptocurrencies are amazing in the sense that they give you a starting gun incentive that most businesses don't get. It's like pushing the first domino down. The most simple behavioral incentive in crypto is if you do this, we will give you a token. If you use our product in X way, you get this token that has a financial value. But it's really dangerous too, because if the entire incentive structure is not deeply and completely thought through, the entire system can fall apart. And so the crypto economics that goes into designing a financial protocol is complex and it's hard. And even if it works, it still doesn't guarantee that anybody is actually going to want your token. And a big reason for that is that there are way more tokens today than there used to be. This tweet says that there are 36.4 million tokens today compared to 3,000 tokens from the 2017, 2018 cycle. That number includes an enormous amount of pure spam, but I think it's fair to say that there are between 100 to 1,000 times more real-ish kind of tokens than there were 5 years ago. And there are not enough buyers to buy all of these tokens at all. 90% of crypto buyers are people who work in crypto, professional liquid crypto funds and VCs, explicit traders, and then a little bit of retail. It's mostly a narrative and attention game, sure, but even among quality crypto assets, as in protocols that have real use and some level of real product market fit, and even some level of mind share, nobody really cares about the token right now. There's just not enough capital to buy all of the tokens. And as we've been alluding to throughout this presentation, there's very little consensus on who actually gets to capture value that is being generated by these protocols. I think that the answer here, and it's something that we are starting to see more of, is to have the protocol itself be the primary buyer of the token. The following is just a hypothetical, and it's perhaps me applying a little bit of pressure to the team. But when the protocol is fully live, there will probably be a small fee that goes to the protocol itself. A good use of that fee is to automatically buy back the token on the open market and either burn it, which reduces the supply and increases scarcity, or holds on to the token. And if the protocol holds on to the token, it can be used again as another incentive mechanism to maybe like sustain solver activity or crowd liquidity in perpetuity. And so even though we may be working as a company in the association to strike lightning in terms of public attention, we want to set up our system so that the protocol itself can run sustainably if we set it up right, and the token can have a healthy market. Now, this is not a magic bullet either, because MakerDAO that I highlighted earlier has been buying and burning its token for over a year, and the price has been down. It's kind of a counterfactual, though, because we don't know how much more it would have been down if it wasn't doing that. But the point is, there are too many tokens out there, and crypto apps have to get creative to combat that. Moving along. Up to this point, layer one blockchains have dominated the crypto ecosystem in terms of valuation. They're overshadowing applications and middleware. There are two main reasons for this dominance. First is that the total addressable market for store of value is significantly higher than for cash flow generating applications. In traditional markets, assets like gold or sovereign currencies are global stores of value with trillions of dollars tied up in them. L1 assets like BTC and ETH are being positioned as non-sovereign digital stores of value, which opens the door to this like massive valuation framework. Second, this perception of value creates a powerful incentive for more and more layer one blockchains to launch. So each new blockchain wants to be able to capture its share of store of value trillion-dollar markets by marketing itself as the next dominant L1. And it's like it's this self-fulfilling cycle where more and more L1s are launching, and people see that L1s are the highest valuation things, and so they're buying into them. But how much of that does that really work? The result is this like abundance of layer ones trying to find its place in the crowded ecosystem. But this raises like a really essential question. How many layer one assets can genuinely justify a store of value valuation? For an L1 to succeed in this role, it needs more than just speculative hype. It must prove its ability to establish robust economic activity and sustain adoption in the long term. Ultimately, the market for store of value layer ones is likely to converge on a few dominant players, which is going to make it harder and harder for new entrants to sustain these like super high valuations in a competitive environment. If we think of crypto as the economy of the continent of the internet, then layer one blockchains function kind of as countries or economic zones, while the applications on top of them are akin to the companies today that are driving economic activity. Together, they form the foundation of like a new internet economy, a decentralized financial system that operates across borders and beyond the control of any single nation state. But when we consider how value will concentrate long term, power law dynamics offer a pretty useful lens. Historically, markets with network effects tend to produce a small number of dominant winners. So for crypto, this suggests two plausible scenarios. Either there is a single dominant winner that emerges as the digital store of value, with three or four smaller players capturing niche use cases, or we see a more distributed balance, a more balanced distribution among 3 to 4 key L1s or L2s. What seems far less likely is a world where 10 plus layer ones achieve and sustain store of value status. So assets like digital gold or new forms of money rely on a lot of trust and liquidity and network effects, which makes it hard for so many contenders to exist over a long term. And while the current landscape is crowded with new layer ones competing for attention and market share, it's likely that only a handful will endure as the backbone of the internet economy. The rest are going to fade into obscurity as the market consolidates among a few dominant countries in this digital financial world. So is the layer one trade dead? No, the layer one trade is far from dead. Recent examples like SUI, which shot up to a $40 billion fully diluted valuation, or Hyperliquid, which quickly surged to a 20 plus billion FDV, show that there is a lot of market appetite and momentum for new layer ones. Investors and teams remain eager to capitalize on the potential of these networks to carve out their niche in the blockchain ecosystem. But the more interesting question is, should the layer one trade be dead? Because Solana's adoption made sense in a context where Ethereum's high fees limited accessibility. Last bull market transacting on Ethereum could cost $50, while Solana was essentially free. But do we really need an abundance of fast and cheap chains in today's ecosystem? With so many L1s already in the market and new ones constantly launching, it becomes harder and harder to justify each chain getting the level of activity needed to justify store of value valuations. So the challenge lies in building like sustainable network effects, right? A successful layer one must attract and retain users, developers, apps, while also competing with the incumbents and other new entrants. And this is no easy feat, especially because network effects compound and dominant players become harder to displace. And so like two things are true at once. Like one, it's the early days in the blockchain space. The market is like just starting to gradually mature. And network effects are going to likely separate the long-term winners from the speculative hype. But the real question is not whether L1s can launch and capture a trade in the short term. It's whether they can like really thrive in the long term. And so everyone wants to know who is the next Solana. I am just going to like unload the clip and fire some quick thoughts on the possible contenders just for fun, really. SUI, Solana, SUI. Solana demonstrated like real market demand for fast and cheap global state machines, like scaling entirely on the layer one. While Ethereum needs layer twos to scale, oops, oh my, hold on. While Ethereum needs layer twos to scale, Solana handles it all on the layer one, right? And so SUI is another fast, cheap chain having a strong year with price and metrics, but Solana's adoption made sense when Ethereum fees were $50. How necessary are more alternatives? SUI's 2024 metrics have surged, but compared to Solana in 2023, none of these chains have a fraction of Solana's real community, even during the bear market. And so, still bull market valuations differ, and the fastest horses often maintain their lead. And SUI is the largest fast and cheap chain after Solana. Hyperliquid launched on December 1st and is currently valued at a whopping $26 billion values. And I think that Hyperliquid is unique in interesting ways. So Hyperliquid built a custom layer one with no smart contracts with the specific purpose of building an on-chain perpetuals swaps exchange that can match the speed of a centralized exchange like Binance. So the perps product was the goal. They wanted to build a product and they custom built a layer one to make the specific product, which is interesting. The exchange is generating an insane amount of fees, sometimes over 4 million a day, which is over 1.5 billion a year. And those fees are actually almost enough to justify a valuation like this. But the chain is only run by 4 validators, all co-located in Japan. And so it's very easy to make a blockchain fast when there are few computers located in one place. It's very hard to make a blockchain fast when there are computers all around the world. Not exactly decentralized. So for comparison, Ethereum has thousands of validators that sync every 12 seconds. Solana has roughly 1,200 processing blocks in parallel every 400 milliseconds. Hyperliquid has 4 validators. Not exactly centralized, but at least they have some real users. I'd say the Hyperliquid exchange is more legit than the usage of any of these other chains. Aptos is another fast and cheap chain. Both Aptos and Sui use the Move virtual machine for smart contracts. Move appears genuinely interesting, but whether that's a reason to be bullish on an entire chain is unclear. Um, BitTensor is an incentive mechanism for open source AI. Does that make sense? What I like about BitTensor is that half my X timeline thinks that it's really cool and half sees it as absolute nonsense vaporware, and that is a recipe for good memetics. Celestia, technologically, I like Celestia a lot. I think it's genuinely novel and interesting. Celestia, the blockchain, basically does nothing except basic transactions like Bitcoin. The difference, though, is that it's like super easy to build layer 2s on top of Celestia and use it as a place to post data and proofs for other layer 2s to post to. I like the ecosystem, but the issue is that the TIA token is not like an obvious shelling point. It's not a source for people to be like, aha, TIA. And so lots of chains use Celestia in the background, but many of them have their own tokens that people might want to buy instead. This has made it hard for the TIA token to get sent to generate sustained attention. Telegram has a massive global user base, but it's unusual smart contract language. Avalanche has been around for years. Shout out to Jay. It's probably good technology. It still has over $1 billion locked. It's not a ghost chain. It's proven BD success, but it's not shiny and exciting. Like, make of that what you will. It's kind of interesting to think about in the question of exploring value in crypto assets. What do you think about how hard it is to keep attention on something over the long term while maintaining attention in the short term? How do you value that? Upcoming launches, we've got Monad building an ultra-fast parallel EVM layer 1, highly anticipated, but we will see what the plan is to launch a robust ecosystem. Barachain might be launching next week. They have a novel emissions mechanism where instead of inflation going to stakers or miners, it goes to the TVL that is on the chain. So if you keep money in a DeFi platform on Barachain, you earn token emissions. And that's a pretty interesting user acquisition strategy for getting TVL on the chain. So that is something interesting. Sonic is a Phantom Chain rebranding as another ultra fast EVM a la Monad. All of these chains are probably not serious contenders for store of value status at this stage. I also did not list any Ethereum layer 2s, but I just wanted to give it some quick takes on that there. I think we've got 2 more slides, almost done. Keep talking fast. How special is Bitcoin? Are we witnessing a Bitcoin supercycle where institutional capital floods into BTC but never trickles down to long tail altcoins? Like, this scenario would cement Bitcoin's dominance as like the flagship crypto asset with its store of value narrative driving the majority of institutional interest. I see a lot of new people with little to zero BTC exposure because they think it's too big already. And it makes me nervous when we're seeing this level of like nation state adoption. But this dynamic also raises like pretty important questions about Bitcoin's future position in the broader crypto ecosystem. If Bitcoin remains siloed and fails to interoperate with other blockchain ecosystems, it really risks hurting its long-term potential, in my opinion. I believe that the crypto economy represents the native economy of the internet and that it will rival the US and China as an economic power. And Bitcoin, as it stands today, is not capable of powering the internet economy. If you could build or if you could bridge BTC to Ethereum or Solana in a trust minimized way, or you could build a rival layer 2 directly on Bitcoin, BTC could power the crypto economy, but right now it cannot. And so if BTC is just digital gold, it could still be worth $3 to $5 million a coin. But I believe that if Bitcoin is just digital gold, that it will get flipped eventually. Sorry, Zev. So yes, I'm sitting here at a time when the smartest people in the world are just starting to come around to Bitcoin, and nation states might seriously be about to adopt it. And I am saying that Bitcoin could go to $5 million a coin and that it could still get flipped, because being a productive asset, a commodity money that powers the digital economy and generates a real yield, is a bigger market than just being digital gold. And so coming back to power laws, the common consensus is that there will just be one true winner. But if BTC is just digital gold, then I think that there is room for two giga winners, one digital gold, Bitcoin, genuinely, truly exciting and super valuable, and a second asset on an equal level, emerging as the store of value as the internet economy. And so I recognize that Bitcoin dominance might rise over the next 5 years. I wouldn't be surprised. And there are some genuinely promising Bitcoin L2s coming. But to me, the race is on. Either BTC becomes an asset that can interoperate with the rest of the crypto economy, or it will be dethroned. And this is a hot take right now, especially right now. But I would put the odds at 50-50 that Bitcoin eventually gets flipped. Last slide. So wrap it all up. Layer one blockchains like Bitcoin, Ethereum, and Solana have long held the lion's share of the value in the crypto market. But the question is for how long, and how many layer ones can truly justify their valuations as global stores of value? And how do you balance the fact that layer ones might catch a bid in the short term, but most are going to have a reckoning in the long term? How fat are middleware protocols? Middleware protocols that power cross-chain messaging, data availability, and other core functions are rapidly rising in number and are genuinely providing useful services, but they don't have as clear of a mechanism to capturing fees. So will middleware protocols follow the fat protocol thesis and capture significant value, or will they remain secondary to both layer ones and user-facing applications? And apps are generating more revenue than ever, but does that matter? Apps are thriving and they're out earning many layer ones and are driving real economic activity. But does higher revenue generate to greater value capture for the token? Or will the infrastructure and the protocols enabling these apps still hold the upper hand when it comes to long-term market dynamics? So all of these questions kind of highlight some of the shifting dynamics in the question of value in the crypto stack, and we will just kind of have to see how things keep developing and position ourselves to succeed no matter what. And that is all. Thank you guys for your time.
Thank you, Sean. Come back here next Wednesday and you can agree with Sean, debate him, fight him, whatever you want to do. But thank you so much. We'll post this recording if anyone didn't get to see it, and let's talk about it live next Wednesday.
Cheers, guys. Bye.